So a couple of ways to answer that. Debt and equity is what we do, right? And then within equity, we have both growth equity. We also have distress investing on the equity side. So we're trying to play all the time the different parts of the economy, what's happening with liquidity, illiquidity, and stuff that we do. Big area for us is private debt, but in real estate debt, valuations have come down dramatically over the last several years. We have been arguing for a while that fourth quarter 2023 was the low point in real estate valuations in the U.S., and we've seen it bounce off the bottom from there. But you're still relatively low, with relatively strong economic growth and undersupply in housing, logistics, a whole bunch of things. If you remember, we had the Silicon Valley Bank crisis. 85% of all real estate construction loans in the United States were provided by regional banks. The feds and the regulators tightened up all the capital treatment, so we've had a noticeable drop-off in new deliveries and new development, to the point that if you look at a housing graph of what was constructed, last year was the highest point of delivery, and then it almost drops to zero when you look at it. And we're still 4 to 7 million units short in the United States for housing. So we like that for both debt and equity, but for debt, for construction debt and other areas on a risk-adjusted return, we think that's pretty interesting, particularly for insurance capital, how you think about it. On the equity side, we've got this sort of tale of the haves and the have-nots, and talking about policy changes and things. In the logistics sector, you have two sort of big things that are happening. One, away from data centers, you have $1 trillion of announced advanced manufacturing broken down into a whole bunch of subcomponents. One of the biggest is pharmaceuticals. That started during COVID in terms of the onshoring, re-onshoring. It's about $300 billion of announcements of new development. Eli Lilly itself right now has about $20 billion in 3 facilities under development. That all requires all new logistics. That's happening. And we see that time and again in the advanced manufacturing onshoring. The have-nots on the other side are all the port markets and logistics, which have gotten hurt with trade and tariffs. So you're seeing that as dislocated, not really truly distressed, but really dislocated in more value-add, higher return markets, if you believe those markets will stabilize over time, which we do.